Imagine waking up every morning to see your bank balance grow by over $5,000 each month, effortlessly. I've unlocked the secret to generating passive income that 97% of people overlook. So keep watching till the end, and don't forget to like and subscribe. In this video, I'll reveal how I ditched my 9-to-5 grind and embraced 7 powerful investments that consistently funnel money into my account month after month. Ready to transform your financial future? Let's dive in. 1. Dividend-paying stocks. Dividend-paying stocks are essentially shares in companies that return a portion of their profits to shareholders in the form of dividends. Think of it as being a partial owner of a company and getting a slice of the earnings regularly. This regular payout is a share of the profits based on the number of shares you own. For instance, if a company earns a significant profit, it might decide to distribute a percentage of this to its shareholders as a reward for investing in the company. This makes dividend stocks an attractive option for those looking to generate passive income, as they provide periodic payments without requiring shareholders to sell their stakes. How dividends work. Dividends are payments made by a corporation to its shareholder members. It is the portion of corporate profits paid out to stockholders. When a company earns a profit, it can reinvest it in the business, called retained earnings, and pay a portion as a dividend to shareholders. Dividends can be issued as cash payments, as shares of stock, or other property. For example, if you own 100 shares of a company that pays a dividend of $5 per share, you would receive $500 in total whenever dividends are paid. These payments usually occur quarterly, but can also be paid monthly or annually, depending on the company's dividend policy. Benefits of investing in dividend stocks. Regular income. Dividend stocks provide a steady source of income that is paid out at regular intervals, typically quarterly. This is particularly beneficial for retirees or those seeking a consistent income stream to supplement their earnings. The reliability of receiving dividends can help stabilize an investor's cash flow, as these payments are made regardless of the stock's day-to-day market price fluctuations. Reinvestment. One of the significant advantages of dividend stocks is the ability to reinvest dividends to purchase additional shares of stock. This practice, known as dividend reinvestment, can significantly enhance an investor's return over time through the power of compounding. Essentially, each reinvested dividend buys more shares, which in turn will generate their own dividends, thereby increasing the overall return on the initial investment. Safety. Dividend-paying stocks are often seen as safer than those that do not pay dividends. This perception is based on the nature of the companies that are able to pay dividends consistently. They are typically well-established and financially stable, with a long track record of distributing earnings back to shareholders. These companies have predictable profit patterns and strong business models, which can endure economic downturns better than less established companies. Volatility mitigation. Dividends can also help mitigate the price volatility of a stock. In turbulent market conditions, dividend payouts can provide a return on investment that may not be dependent on the stock price, which can fluctuate widely. Investors might see dividends as a form of yield support, as they can cushion the downside when stock prices fall, providing a partial hedge against market volatility. Example of a reliable dividend-paying company. Coca-Cola exemplifies a reliable dividend-paying company with a robust history of stable and increasing dividend payouts. It has been paying dividends since 1920, demonstrating a strong commitment to returning value to shareholders even during economic downturns. Investing in Coca-Cola could be likened to having a steady job that pays regularly, providing a reliable income stream without the physical effort typically associated with earning a wage. Strategies for selecting the best dividend stocks. When selecting dividend stocks, investors should consider the following criteria. Dividend yield. The dividend yield is a key metric, calculated as the yearly dividends per share divided by the price per share. It provides an indication of the cash flow an investor might expect relative to their investment size. A higher yield can be attractive, but it's essential to consider the sustainability of the dividend. Dividend history. Companies with a history of stable and progressively increasing dividends are often preferred. This track record suggests financial health and a reliable commitment to returning shareholder value. It also reflects the management's confidence in the company's ongoing cash flow. Financial health of the company. Analyzing a company's earnings, debt levels, and cash flow is crucial. A company with stable or growing earnings and manageable debt is more likely to sustain its dividend payouts. Investors should examine the payout ratio, which indicates what proportion of earnings is being paid out as dividends. A payout ratio that is too high may not be sustainable in the long term. Risks and considerations. Investing in dividend stocks is generally considered safer than speculative stocks, but it comes with its own set of risks. Market risk. All stocks are exposed to market risk, which can affect their prices irrespective of the company's earnings or dividends. Economic downturns. In recessions or downturns, even strong companies may reduce or suspend dividend payments if their earnings are affected. Overexposure. Investors who rely too heavily on dividends and concentrate their portfolio in dividend-paying stocks may face sector-specific risks if economic factors adversely affect the sectors these companies operate in. While dividend stocks provide a regular income stream and enhance safety, selecting the right stocks requires careful consideration of the company's financial health and broader market conditions. With prudent selection and ongoing monitoring, dividend stocks can be a valuable addition to an investment portfolio, offering both income generation and potential capital appreciation. Don't miss out on more insights like these. Hit that subscribe button. Drop a comment below with your thoughts or questions about dividend-paying stocks. 2. Bonds. Bonds are essentially loans that you, as an investor, give to companies, governments, or municipalities. In exchange for your loan, the issuer promises to pay back the principal amount on a specified maturity date and make periodic interest payments along the way, often referred to as coupon payments. This setup is akin to lending money to a reliable friend who agrees to pay you back with interest as a thank you for your help. Bonds are typically a safer investment than stocks because they offer predictable returns and are prioritized over stocks for repayments in the event of a company's liquidation. How bonds work: principal and interest. When you purchase a bond, you are essentially lending money to an issuer, such as a government or corporation, in exchange for periodic interest payments plus the return of the bond's face value when it matures. The principal is the amount you lend, and the interest is the income you earn from lending this money. For instance, if you buy a bond for $1,000, the principal, with an annual interest rate, coupon rate, of 5%, you'll receive $50 each year, the interest, until the bond matures, at which point the issuer will return the original $1,000 to you. Maturity. A bond's maturity date is the specified time at which the principal amount of the bond is to be paid back to the bondholder, ending the bond issuer's obligation. Maturities can vary widely, from a few months to several decades, and the length of the maturity period can affect both the interest rate and the risk associated with the bond. Issuers. Bonds can be issued by a variety of entities. Federal governments often use bonds to fund current expenditures with future revenues. These are generally the safest type of bonds, with U.S. Treasury bonds being the prime example. Local municipalities issue bonds to fund public projects like roads, schools, and hospitals. These bonds might offer tax exemptions, an attractive feature for many investors. Corporations issue bonds to raise money for various reasons, such as expanding operations, acquiring other companies, or refinancing old debts. These are typically riskier than government bonds and therefore offer higher interest rates. Safety. Bonds are traditionally viewed as less risky than stocks. They provide predictable income through regular interest payments, and because the principal is returned at maturity, there is a lower risk of loss compared to stocks. However, the safety of a bond depends on the issuer's creditworthiness and the bond's duration and interest rate environment. Different types of bonds. Corporate bonds, issued by private and public corporations. These bonds are used to raise funds for capital-intensive projects, operational needs, or to refinance existing debts. The interest rates on corporate bonds are typically higher than those of government bonds because there is a higher risk that a company could fail to fulfill its financial obligations. Municipal bonds. These bonds are issued by cities, towns, states, and public commissions. Municipal bonds are attractive to investors because they often provide tax-free interest income, which can be especially beneficial for those in higher tax brackets. Government bonds. Considered the safest type of bonds, government bonds are issued by national governments. In the United States, these are known as treasuries, backed by the full faith and credit of the federal government, virtually eliminating the credit risk. Other types of government bonds can include savings bonds and agency bonds. Benefits of investing in bonds: predictable income. Bonds provide investors with a predictable income stream through regular interest payments. This predictability makes bonds an attractive investment for those who need to plan for steady cash flow, such as retirees. Safety. Compared to stocks, bonds offer a higher level of security with lower volatility. The repayment of principal at maturity provides an additional layer of financial safety, and the fixed interest payments help cushion economic fluctuations. Diversification. Adding bonds to an investment portfolio can greatly enhance diversification, which helps reduce overall investment risk. Because bonds often perform differently than stocks under various economic conditions, they can stabilize a portfolio's returns when the stock market is down. Investing in bonds is a strategic choice for investors seeking steady income with lower risk. Understanding the different types of bonds and how they function within the broader financial system can help investors make informed decisions tailored to their financial goals and risk tolerance. Example of how bonds pay interest. Let's delve deeper into how bonds generate income through an example involving a municipal bond. Imagine you decide to invest $5,000 in a municipal bond that has an annual interest rate of 4%. This means that each year the bond will yield 4% of the $5,000 you invested, which amounts to $200. This payment is typically made semi-annually, meaning you would receive $100 every 6 months. After holding the bond for 10 years, it reaches its maturity date. At this point, you would have received a total of $2,000 in interest payments over the life of the bond. Upon maturity, the issuer also pays back the initial principal amount of $5,000. Thus, the total return on your investment at the end of the maturity period is the sum of the interest payments and the principal, amounting to $7,000. This example illustrates how bonds can be a reliable source of income, as well as a means of preserving capital over time. Advantages and risks of bond investing. Advantages: stability. Bonds are known for their stability. Unlike stocks, bonds offer fixed interest payments, which can provide investors with a predictable and steady income stream. This makes them an attractive option for conservative investors or those in need of regular income, such as retirees. Income generation. The regular interest payments made by bonds provide a continuous source of income, which can be reinvested or used to cover living expenses. This aspect of bonds is particularly valuable during times of market volatility, as it offers a cushion against fluctuations in stock prices. Risks. Interest rate. Risk. This risk arises from changes in market interest rates. If interest rates increase, the market value of existing bonds with lower interest rates typically decreases. This can be a significant risk if you need to sell a bond before it matures, as you may receive less than the principal amount invested. Credit risk. There is always a risk that the bond issuer may fail to make interest payments or return the principal at maturity. This risk is higher with corporate bonds, especially those issued by companies with lower credit ratings. Government bonds, particularly those issued by stable governments like the US, generally carry lower credit risk. Tips for building a bond investment portfolio. To effectively manage a bond investment portfolio, consider the following strategies. Diversify across types. Diversification is key to managing risk in any investment portfolio. By including government, municipal, and corporate bonds, you can balance potential returns with risk. Each type of bond carries different levels of risk and return, influenced by factors such as issuer creditworthiness and interest rate sensitivity. Consider maturity lengths. Bonds with different maturity lengths respond differently to changes in interest rates. Short-term bonds are less sensitive to interest rate changes, but typically offer lower returns. Long-term bonds, while offering higher returns, carry increased interest rate risk. Balancing your portfolio with short, medium, and long-term bonds can help manage these risks. Assess credit ratings. Credit ratings provided by agencies like Moody's and Standard & Poor's are crucial in assessing the risk level of bonds. Higher-rated bonds, e.g. AAA or AA, are deemed safer but generally offer lower returns compared to lower-rated bonds, e.g. BB or B, which are riskier but offer higher returns. Understanding and implementing these strategies can enhance the stability and performance of your investment portfolio, making bonds a foundational element of diversified investment strategies tailored to meet specific financial goals and risk tolerances. Enjoying the content? Subscribe for more financial tips. Let us know in the comments what you think about investing in bonds. 3. Real estate investment trusts, REITs. Real estate investment trusts, REITs, provide a way for individuals to invest in large-scale income-generating real estate without having to directly buy, manage, or finance any properties themselves. Imagine investing in a portfolio that includes a variety of property types such as shopping malls, office buildings, apartments, and hospitals. Rather than purchasing a single property, investing in a REIT allows you to own a fractional share of a broad real estate portfolio. This setup enables you to earn a portion of the income generated from rental payments, similar to how shareholders receive dividends from their stock investments. REITs are legally required to distribute the majority of their taxable income to shareholders, making them a popular choice for income-seeking investors. How REITs operate? REITs pool capital from multiple investors to purchase and manage real estate properties. They operate under a specific regulatory framework which mandates that they distribute at least 90% of their taxable income to their shareholders in the form of dividends. This requirement not only ensures a steady flow of dividend payments to investors, but also provides REITs with a favorable tax treatment. Here's how the mechanism works. Capital collection. REITs raise capital by selling shares to investors on public exchanges, similar to how public companies issue stock. Investment in real estate. The funds collected are used to acquire a diversified portfolio of real estate properties, which may include offices, retail spaces, residential units, and other types of real property. Income generation. These properties generate income primarily through leasing space to tenants. The income collected from rents is then used to manage properties, pay necessary expenses, and distribute dividends to shareholders. Dividend distribution. To maintain REIT status, at least 90% of the taxable income must be returned to investors annually. For example, if a REIT earns $1 million from rent and other property-related income, it must distribute at least $900,000 to its shareholders as dividends. Reinvestment. Any retained earnings can be reinvested into further property acquisitions and improvements, supporting the growth of the REIT's asset base and potential for future income. This structure allows REITs to provide regular income streams and potential for capital appreciation while offering investors liquidity that is not typically available with direct real estate investments. Benefits of investing in REITs. High dividend yields. REITs are required to distribute the vast majority of their taxable income to shareholders, which often results in higher dividend yields compared to other equities. This makes REITs particularly attractive to income-focused investors. The consistent dividend payouts provide a regular income stream and can be a significant part of total investment returns. Diversification. Investing in REITs offers a practical means of diversification. Since real estate markets often behave differently than other sectors in the financial markets, adding REITs to a portfolio can lower overall volatility and risk. Diversification across different types of real estate properties and geographical areas can further mitigate risk and stabilize returns. Liquidity. Unlike direct real estate investments, REITs offer considerable liquidity. Since they are traded on major stock exchanges, shares of publicly listed REITs can be bought and sold during trading hours at market prices. This feature allows investors to quickly adjust their investment positions in response to changes in market conditions or personal financial needs. Overall, REITs serve as an accessible, liquid, and yield-generating investment vehicle, suitable for both seasoned and novice investors seeking exposure to the real estate sector without the complexities of direct property ownership and management. This blend of benefits explains the growing popularity of REITs among a broad array of investors looking for both income and long-term capital growth. Types of REITs. Equity REITs. Equity REITs own and manage real estate properties and earn income primarily through leasing space within these properties to tenants. They invest in a range of real estate, including residential complexes, office buildings, industrial sites, and retail spaces. The revenues are mainly generated from rental income. Equity REITs may also profit from the sale of properties that have appreciated in value. These REITs are the most common type and are appreciated for their potential to provide both steady income and capital appreciation. Mortgage REITs, MREITs. Mortgage REITs provide funding for real estate by purchasing or originating mortgages and mortgage-backed securities, MBS. They earn income from the interest on these financial instruments. MREITs are exposed to the risk of interest rate fluctuations, which can affect the value of the mortgage securities they hold. This type of REI does not own the underlying real estate, but the debt secured by these properties. Hybrid REITs. Hybrid REITs combine the investment strategies of equity REITs and mortgage REITs by both owning properties and engaging in mortgage lending or holding mortgage-backed securities. This allows them to diversify their income streams by generating revenue from both property rents and interest on loans. Example of how to evaluate and select REITs. When evaluating an equity REIT, particularly one specializing in retail properties, consider the following factors. Property portfolio. Assess the number and quality of properties in the REIT's portfolio. More properties generally mean more sources of income, which can provide better security for dividends. Location and tenant quality. The location of the properties and the credit quality of tenants are crucial. Properties in prime locations with high-traffic tenants like national retail chains are more likely to generate stable rental income. Dividend yield. Compare the dividend yield of the REIT to industry averages and other similar REITs. A higher yield can be attractive, but ensure it is sustainable. Growth potential. Look at the REIT's history of dividend payments and property value appreciation. Consistent growth in these areas can indicate a well-managed REIT with potential for future gains. Potential risks and how to mitigate them. Risks. Changes in the economy, such as a downturn, can reduce occupancy levels and rental rates, impacting income. Interest rate risks. Interest rate increases can raise borrowing costs for mortgage REITs and reduce property values, affecting equity REITs. Mitigation strategies. Diversification. By investing across different types of REITs, such as those that hold different kinds of properties, residential, commercial, healthcare, or a mix of equity and mortgage REITs, you can reduce sector-specific risks. Research. Thorough research into a REIT's performance history, management quality, and financial health can prevent investment in poorly managed or financially unstable trusts. This includes reviewing financial statements, dividend history, and future growth strategies. Real estate investment trusts, REITs, offer investors a practical and efficient way to access the real estate sector. They provide the benefits of real estate investment, including regular dividend payments and potential capital appreciation, without the complexities of direct property management. By including REITs in their portfolios, investors can achieve greater diversification and enhance their potential for steady, long-term returns. Subscribe to stay updated on smart investment strategies. Have any experiences with REITs? Share them in the comments below. Peer-to-peer lending. Peer-to-peer P2P lending is a modern financial transaction system that matches borrowers directly with lenders through online platforms, bypassing traditional financial institutions like banks. This innovative form of lending allows individuals to lend money to other individuals or small businesses that need financing. As a lender, you provide the funds for a loan and in return receive interest payments, much like a bank would. This process not only speeds up the borrowing experience due to less red tape, but often provides more favorable terms and interest rates due to the reduced overhead of not having a physical bank involved. For borrowers, it can offer more accessible loans, especially for those who might not qualify for traditional banking products. For lenders, it's an opportunity to earn higher returns on their cash investments than what might be offered through savings accounts or other low-risk investments. How peer-to-peer lending works. Peer-to-peer lending transforms the way individuals access loans and how investors can grow their funds. When you invest $1,000 on a P2P platform, you're not lending to a single borrower, but can distribute your investment across multiple loans. Here's a step-by-step explanation of the process. Choosing a platform. First, you select a P2P platform that suits your investment goals and risk tolerance. Creating an account and depositing funds. You create an account, undergo a verification process, and then deposit the amount you wish to lend. Selecting loans. You can browse through various loan applications, reviewing the borrower's credit rating, the purpose of the loan, and other key details. Platforms often provide a risk assessment to help guide your decision. Diversifying investments. To mitigate risk, you can spread your investment across different loans. For example, instead of lending the entire $1,000 to one person, You might lend $100 each to 10 different borrowers. Receiving payments. As borrowers repay their loans with interest, you receive monthly payments. These payments include both the principal and interest, providing a steady cash flow over the term of the loan. Benefits of investing in P2P lending: higher returns. Generally, P2P lending offers higher returns compared to traditional fixed income investments like CDs or savings accounts. The higher interest rates reflect the greater risk of lending to individuals over credit institutions. Diversification. Including P2P loans in your investment portfolio can reduce overall risk through diversification. Since P2P loans are not tied to stock market fluctuations, they can provide returns even when markets are volatile. Personal connection. P2P lending lets you support individual borrowers or projects that resonate with you personally. Whether helping someone consolidate debt, cover medical expenses, or start a small business, your investment can have a direct positive impact on someone's life. Risks involved with P2P lending. Credit risk. The primary risk in P2P lending is that the borrower may default on their loan. While platforms assess and rate each borrower's creditworthiness, there is always the risk of loan defaults, which can lead to partial or total loss of the lent funds. Platform risk. The stability and security of the P2P platform are vital. If a platform encounters financial difficulties or operational issues, it could affect your investment. Choosing well-established platforms with strong track records can mitigate this risk. Liquidity risk. Investments in P2P lending are not as liquid as money in a savings account or stocks that can be sold quickly. Your funds are tied up until the borrower repays the loan, which could be months or years. Some platforms offer secondary markets to sell your loans, but this is not guaranteed, and selling loans can sometimes result in losses if done before maturity. How to choose the right P2P platform. Choosing the right peer-to-peer P2P lending platform is essential to ensure the security of your investment and to maximize your potential returns. Here are detailed criteria to consider. Detailed information on borrowers. The platform should provide comprehensive details about the borrowers. This includes not only their credit scores, but also their financial history, reasons for borrowing, and other relevant financial data. These details help you assess the risk associated with lending to particular borrowers. More transparent information allows for better decision-making and helps in setting realistic expectations about the risks and returns. Track record of the platform. Opt for platforms that have a proven track record of stability and reliability. Check how long the platform has been in operation and read reviews or testimonials from other investors. Platforms that have successfully navigated through economic downturns or financial stresses are likely more robust and better managed. Also, look into their history of default rates and how they've handled past delinquencies and collections. Automated investing options. Some platforms offer automated investing tools that allow you to set your investment criteria and then automatically place your money in loans that match these criteria. This feature is particularly useful for diversifying your investments across many loans with minimal effort. It ensures that your money is continuously invested, reducing the time your cash sits idle and maximizing potential returns. Example of P2P lending in daily life. Consider the case of Sarah, who needs $5,000 to start a small home-based bakery. Traditional banks have rejected her loan application due to insufficient credit history or small loan amount, which is not profitable for the banks. Sarah turns to a P2P lending platform where her proposal can be directly presented to potential investors. You, an investor looking to support small businesses while earning interest, decide to lend her $100. Your investment, combined with contributions from 49 other investors, fully funds Sarah's loan. Each month, as Sarah repays the loan with interest, you receive a portion of those payments. Through this investment, you not only yield a financial return, but also contribute to someone's dream of starting a business, making this a rewarding and impactful investment. Peer-to-peer lending offers a unique opportunity for individuals to earn interest by lending directly to others, bypassing the traditional banking system. It can deliver higher returns and the satisfaction of having a direct impact on someone's goals or dreams. However, it's crucial to understand the inherent risks and carefully select a reputable platform that aligns with your investment goals and risk tolerance. By doing so, you can effectively manage potential issues and enjoy the benefits of being a P2P lender. Hit subscribe to get the latest on innovative investment opportunities. Curious about P2P lending? Comment below with your questions. 5. Master Limited Partnerships, MLPs. Master Limited Partnerships, MLPs, are investment vehicles that primarily operate in sectors like natural resources, energy, and real estate. Structured similarly to publicly traded companies, MLPs offer units instead of shares, combining the liquidity of a publicly traded company with the tax benefits of a partnership. What makes MLPs particularly appealing is their focus on asset-intensive industries such as oil and gas pipelines, storage facilities, and real estate holdings. These entities bypass corporate income taxes, passing through most of their earnings directly to unit holders, which results in regular, potentially high-yield distributions. This structure not only provides income stability through consistent distributions, but also offers potential for appreciation, driven by the underlying asset performance in sector-specific growth. How MLPs work. Master limited partnerships are formed to leverage the pooling of capital to fund operations and projects within sectors that require significant upfront capital, such as energy infrastructure or large-scale real estate developments. Here's a detailed look at how MLPs operate. Capital collection. MLPs gather funds from a broad base of investors, each of whom buys units in the partnership. This capital is typically used to purchase, maintain, and upgrade physical assets. Income generation. The primary source of income for most MLPs is the fees generated from the operation of assets. For example, an MLP that owns oil pipelines earns revenue by charging oil companies to transport oil across its network of pipelines. This fee-based income tends to be stable and predictable, providing a reliable stream of revenue. Distribution of income. By law, MLPs must distribute the vast majority, typically over 90%, of their taxable income to unit holders. These distributions are usually made quarterly and are what attract most investors to MLPs. Tax treatment. MLPs enjoy a favorable tax treatment as they do not pay corporate income taxes. The tax responsibilities are passed through to the unit holders. Distributions are often considered return on capital and may reduce the cost basis, deferring taxes until the MLP units are sold. Benefits of investing in MLPs. High income potential. MLPs often provide attractive yield distributions that can be significantly higher than those of other dividend-paying stocks or bonds. This high income potential is due to the MLP's requirement to distribute most of their income to unit holders, making them especially appealing to income-focused investors. Tax advantages. One of the most significant benefits of investing in MLPs is the tax advantage. Since MLPs pass through most of their earnings, they avoid the corporate income tax, and taxes on distributions are often deferred. Moreover, a portion of the distribution is usually treated as a return of capital, reducing the unit holder's cost basis and thereby decreasing the taxable amount when the units are sold. Growth potential. MLPs typically operate in sectors linked to fundamental economic activities, such as energy and real estate, which have the potential for growth driven by broader economic and demographic trends. As demand for energy infrastructure or real estate development increases, MLPs positioned in these sectors can experience asset appreciation and potentially higher distributions. Investing in MLPs offers a combination of high income potential, tax benefits, and growth opportunities, making them an attractive option for many investors. However, potential investors should also be aware of the sector-specific risks and regulatory changes that could impact these investments. Understanding these factors is crucial to making informed decisions when considering adding MLPs to one's investment portfolio. Risks of investing in MLPs. Investing in master limited partnerships, MLPs, involves several risks that are important to consider before committing capital. Sector volatility. MLPs often operate in sectors like energy, which are susceptible to economic cycles and fluctuations in commodity prices. For example, oil and gas MLPs can experience significant volatility in distribution levels and unit prices due to changes in oil prices, directly impacting their profitability and financial health. Regulatory risks. MLPs are subject to federal, state, and local regulations that can significantly affect their operations. Changes in tax laws, particularly those affecting the energy sector, can alter the fundamental economics of MLPs. Environmental regulations can also lead to increased operating costs or CapEx requirements, impacting profitability and distributions. Interest rate risks. Because MLPs frequently use debt to finance acquisitions and other capital expenditures, rising interest rates can increase their borrowing costs, reducing cash flow available for distributions to unit holders. Higher interest rates may also lead to a revaluation of MLP units in the market, typically resulting in lower prices. How to select the right MLP? When investing in MLPs, several factors should be considered to ensure a sound investment decision. Track record and stability. Evaluate the historical performance of the MLP, focusing on its ability to maintain stable and reliable distributions over time. Consistency in meeting distribution commitments can be a good indicator of management's effectiveness and the underlying business's stability. Sector analysis. Different sectors present unique risks and opportunities. For instance, an MLP operating in renewable energy might face different regulatory and economic conditions than one in fossil fuels. Assessing the sector's long-term prospects and how well the MLP is positioned within that sector can guide investment decisions. Financial health. Review the MLP's financial statements to assess its profitability, debt levels, and cash flow stability. An MLP with a strong balance sheet, reasonable debt levels, and consistent cash flow is more likely to sustain distributions and withstand economic downturns. Example of MLP investment in daily life. Imagine you invest in an MLP that owns and operates a portfolio of commercial real estate, such as shopping malls and office buildings. This MLP generates income by leasing space to various tenants, ranging from retail stores to corporate offices, and you as a unit holder benefit from this arrangement. Every quarter, the MLP distributes a portion of the collected rent to its investors after covering operational expenses. This setup allows you to receive regular income distributions, akin to receiving rent from a property you own, but without the hassles of direct management or property maintenance. Master Limited Partnerships, MLPs, present a compelling investment opportunity, particularly for those seeking regular income and favorable tax treatment. However, like all investments, they carry risks, particularly related to sector volatility, regulatory changes, and interest rate fluctuations. Careful consideration of these risks, coupled with thorough due diligence on the MLP's track record and financial health, is essential to making a prudent investment decision. By understanding and managing these risks, investors can better position themselves to benefit from the potential rewards that MLPs offer. Subscribe for more expert investment advice, and don't forget to comment if you're interested in learning more about MLPs. 6. Annuities. Annuities serve as a financial safety net, particularly valuable during retirement. When you purchase an annuity, you make a single lump sum payment or a series of payments to an insurance company. In return, the insurer promises to pay you a steady, predictable income for a specified period or for the rest of your life, depending on the type of annuity you select. This arrangement offers peace of mind and financial security, ensuring that you do not outlive your resources. Annuities are especially beneficial for retirees looking to supplement their income beyond what Social Security and other retirement savings provide, offering a reliable means to manage financial longevity in post-retirement years. How annuities work. An annuity is essentially a contract with an insurance company designed to protect against the risk of outliving your savings. Here's a detailed look at how annuities function. Payment phase. You contribute to the annuity through a lump sum or periodic payments. These contributions are then invested by the insurance company according to the terms of your specific annuity contract. Accumulation phase. The money you invest grows on a tax-deferred basis over time. This means you don't pay taxes on the investment gains each year, which allows your money to grow faster. Distribution phase. Depending on the type of annuity, you can opt to start receiving payments immediately or at a future date. These payments can be structured to last for a certain number of years or for your entire life. For example, investing $100,000 in an immediate annuity might guarantee you a fixed monthly payment of $500, starting immediately upon retirement and continuing for the rest of your life. Death benefit. Some annuities also include a death benefit that pays out the remaining value of the annuity to a named beneficiary if you pass away before receiving the full value of your investment. Types of annuities. Immediate annuities. These annuities begin to pay out soon after the initial investment is made. They are particularly suitable for retirees or those close to retirement age who need reliable income quickly. Once the investment is made, payments start within 12 months and continue for the agreed-upon term or for life. Deferred annuities. With deferred annuities, payments begin at a future date, often after many years. This delay allows the investment to grow over time, increasing the eventual payout. Deferred annuities are ideal for younger individuals who are still in the workforce and can afford to wait for their payouts. Fixed annuities. Fixed annuities offer payments that are guaranteed in amount, providing a stable income stream regardless of changes in the market or the economy. This predictability makes them a safe choice for individuals who need assurance about their future income. Variable annuities. Variable annuities allow payments to fluctuate based on the performance of investment options chosen by the annuitant, such as mutual funds. While they offer the potential for higher returns compared to fixed annuities, they also carry more risk since payments can vary with market conditions. Each type of annuity offers distinct advantages and serves different financial needs and risk tolerances. Choosing the right annuity involves evaluating your financial situation, your income needs, and your comfort with risk. Benefits of investing in annuities. Steady income. The primary benefit of annuities is the provision of a steady, predictable income stream, which is invaluable for retirees who need consistent financial support to cover living expenses. This makes annuities a reliable foundation for a retirement plan, as they can help mitigate the risk of outliving your savings. Tax deferral. Annuities offer tax-deferred growth, meaning that the money invested grows free of tax until withdrawals begin. This can significantly enhance the growth potential of your investment over time, as earnings compound without being reduced by taxes each year. This feature is particularly advantageous for individuals in higher tax brackets during their earning years. Flexibility. Annuities come in various forms, including fixed, variable, and indexed, allowing investors to choose an annuity that best aligns with their risk tolerance and financial goals. Each type offers different benefits, such as guaranteed returns with fixed annuities or the potential for higher returns linked to market performance with variable annuities. Risks and considerations of investing in annuities. When considering the purchase of an annuity, it is crucial to weigh not only the benefits, but also the potential risks and challenges associated with these financial products. Here's a detailed look at the key risks and considerations. Fees and charges. Sales commissions. Many annuities are sold by financial advisors or brokers who earn a commission on these products. These commissions can be substantial and are often built into the cost of the annuity, which can impact the initial investment amount or reduce the overall returns. Management fees. Particularly with variable annuities, there are often annual management fees associated with the investment options within the annuity. These fees are similar to those charged by mutual funds and can vary significantly depending on the underlying investments. Insurance charges. Annuities often include insurance features, such as death benefits or riders that guarantee minimum payouts, which come with additional costs. These insurance charges compensate the insurer for the risk they undertake and can reduce the investment's growth. Surrender charges. If you withdraw money from an annuity within a certain period after the purchase, often within 5 to 7 years, but sometimes as long as 10 years, you will likely face surrender charges. These fees can be a significant percentage of the withdrawn amount and are meant to discourage early withdrawals. Inflation risk. Eroding purchasing power. Fixed annuities provide regular, predictable payouts, which are an attractive feature for many retirees. However, these payouts do not typically adjust for inflation. Over time, inflation can erode the purchasing power of these payments, potentially reducing the standard of living that these payments can support. Long-term impact. For individuals who retire early or those who live longer than average, the impact of inflation can be particularly pronounced, as their fixed payments buy less and less over time. Inflation risk is a crucial factor to consider for anyone relying on fixed annuities as a significant part of their retirement income. Complexity, understanding. Contractual details. Annuities can come with a host of options and features, including various riders, choice of annuitization periods, and different payout options. Each of these choices can significantly affect the performance and suitability of the annuity for a particular investor. Impact on performance. Features like death benefits and guaranteed withdrawal benefits may provide additional security, but they also come at a cost. These costs can reduce the effective yield on the annuity and may complicate the decision-making process. Suitability. Given the complexity and the long-term nature of annuities, understanding whether a specific annuity product is a suitable investment given one's financial situation, goals, and risk tolerance is essential. This often necessitates professional advice to navigate the complexities and ensure that the chosen product aligns with the investor's needs. Annuities can offer valuable benefits, such as steady income and tax advantages. However, the potential drawbacks, high fees, inflation risk, and complexity require careful consideration. Prospective buyers should thoroughly evaluate these factors and consult with financial professionals to ensure that an annuity fits well within their overall retirement strategy and can meet their long-term financial goals. Understanding these risks and how to manage them is crucial in making an informed decision about whether an annuity is appropriate for securing one's financial future. How to choose the right annuity. Choosing the right annuity is a critical financial decision that requires a detailed evaluation of your personal financial situation, understanding the complex features of annuities, and considering the long-term implications of the annuity contract you choose. Here's a detailed guide to help you make an informed decision. Assess your needs' income timing. Determine when you will need the income from the annuity. If you need income immediately, an immediate annuity might be appropriate, where payments start shortly after a lump sum is invested. If you are still years away from retirement and can afford to let your money grow, a deferred annuity may be more suitable, allowing your investment to accumulate earnings, tax-deferred, until you begin to take withdrawals. Income duration. Consider how long you need the payments to last. Some annuities offer lifetime payments, ensuring you do not outlive your resources, while others provide payments for a specific number of years. This choice impacts the payment amount and the security of knowing you have guaranteed income for life or a predetermined period. Financial goals. Reflect on your broader financial goals. Are you looking for stable, predictable returns, or are potential higher returns with more risk more appealing? This will influence whether a fixed, variable, or indexed annuity is best suited to your risk tolerance and financial objectives. Understand the fees and initial commissions. Some annuities come with high initial commissions that can eat into your invested capital. Understanding these fees is crucial as they can impact the amount of money actually being put to work. Annual fees. Annuities often have annual management fees, especially variable annuities linked to investment accounts that require active management. These fees can vary significantly and affect your annual returns. Surrender charges. Many annuities impose penalties for early withdrawals above the free withdrawal allowance. These surrender charges can be substantial in the early years of the annuity contract. Understanding these penalties is essential, especially if you foresee a need to access these funds before the surrender period expires. Rider fees. Optional features, or riders, such as a death benefit or guaranteed minimum income benefit, can be added to annuities for an additional cost. While these can provide added security, they also increase the overall cost of the annuity. Consult a financial advisor expert guidance. Annuities are complex financial products. A financial advisor can help you understand the different types of annuities, the insurers that offer them, and the specific features of each product. Personalized assessment. A financial advisor can assess your financial situation, risk tolerance, and retirement goals to recommend the most suitable annuity type. They can also help you understand how an annuity fits into your overall retirement plan, considering other sources of retirement income in your tax situation. Ongoing support. The financial landscape and your personal situation may change, necessitating adjustments to your retirement plan. A financial advisor can provide ongoing support and advice, helping you make adjustments to your annuity choices as needed. 7. Money market funds. Money market funds provide a practical solution for managing short-term financial needs without sacrificing potential earnings from idle cash. These funds operate similarly to savings accounts, but typically offer higher interest rates, making them an ideal place to store funds that you might need readily accessible, such as emergency savings or money set aside for upcoming expenses. Unlike savings accounts, which may have lower returns due to the costs of banking services and brick-and-mortar operations, money market funds invest in low-risk, short-term debt that enables them to offer competitive interest rates. As a result, they are a favorable option for investors looking for a safe place to park their money temporarily without the typical constraints and lower returns of traditional bank savings accounts. How money market funds work. Investment strategy. Money market funds invest in highly liquid, short-term, high-quality debt securities. This includes instruments such as government bonds, treasury bills, bankers' acceptances, commercial paper, and certificates of deposit. The securities they invest in are typically of high credit quality and short maturity, which helps minimize risk. Safety and liquidity. One of the main appeals of money market funds is their focus on capital preservation. They aim to maintain a stable net asset value, NAV, of $1 per share. While not guaranteed, the $1 NAV makes these funds similar to checking accounts in their stability, but with the potential for higher yields. This stability is crucial for investors looking for a safe place to keep funds that are both secure and liquid. Accessibility and yield. For instance, if you invest $10,000 in a money market fund with an annual yield of 1.5%, you would expect your investment to grow by $150 over the year. The key advantage here is liquidity. Money market funds allow you to withdraw your investment at any time without penalty, which is not always the case with other types of funds or investment accounts. This makes money market funds highly attractive for storing emergency funds or short-term savings. Pricing and redemption. Shares in money market funds can be bought or redeemed at the end of each trading day at the fund's current NAV. The NAV of money market funds rarely fluctuates significantly because the funds invest in very short-term securities. This provides a stable platform for investors who need assurance that the value of their principal will not be subject to market fluctuations. Interest rate and market conditions. The interest rates on money market funds can vary based on overall economic conditions and the Federal Reserve's monetary policy. During periods of higher interest rates, money market funds typically offer better returns. However, in a lower interest rate environment, returns on money market funds may decrease, although they generally continue to offer better returns compared to regular savings accounts. Money market funds are an excellent option for investors who need a combination of liquidity, safety, and a better return on short-term cash reserves than what's typically available through standard bank accounts. While they offer a higher interest rate than savings accounts, the rates are still relatively low, making money market funds best suited for short-term financial goals rather than long-term growth. As with any investment, understanding how these funds fit into your overall financial strategy is key to effectively using money market funds to your advantage. Benefits of investing in money market funds. Liquidity. Money market funds are highly liquid, providing the flexibility to access your funds quickly and without the fees or penalties associated with other investment types. This makes them an ideal choice for parking cash that you may need in the short term, such as emergency funds or money set aside for upcoming expenditures. Safety. These funds invest in very safe assets, such as government securities, treasury bills, and short-term corporate debt, which are considered low risk. This safety is paramount for investors who prioritize capital preservation over higher returns, making money market funds a secure place to store funds that may be needed unexpectedly. Higher yields than savings accounts. While not designed for high returns, money market funds generally offer higher yields compared to traditional savings accounts, especially in a higher interest rate environment. This can provide a modest but steady return on cash that would otherwise earn minimal interest in a standard bank account. Risks and considerations. Interest rate risk. Although typically stable, money market funds can still be affected by movements in interest rates. When rates rise, the existing securities in the fund's portfolio, which have lower interest rates, may decrease in value, albeit slightly. This is a mild risk compared to other fixed income investments, but worth considering. Low returns. The trade-off for the safety and liquidity of money market funds is that they offer lower returns compared to more aggressive investment choices like stocks or long-term bonds. Investors looking for growth or significant income may find money market funds less attractive. Fees. Operational fees, such as management fees or administrative expenses, can impact the net yield of money market funds. While these fees are generally lower than those of more actively managed funds, it is crucial to consider them when calculating potential returns, as they can diminish the overall financial benefit of the investment. How to choose the right money market fund. Low expense ratios. Seek out funds with low expense ratios, as these costs can significantly reduce your overall returns. Even small differences in fees can have a substantial impact over time, especially in a low-yield environment where every fraction of a percent in returns counts. High credit quality. Invest in funds that hold high credit quality securities. Funds that invest in government securities or high-rated corporate debt offer greater safety. This can be particularly important in times of market stress when the quality of the underlying assets can impact the stability of the fund. Fund performance. While money market funds are generally stable, performance can still vary based on the fund manager's expertise and the specific assets held within the fund. Compare the historical performance of different funds, looking at their yields over time and how they have managed during periods of interest rate volatility. Accessibility and services. Consider how easy it is to access your funds and what services the managing institution offers. Features such as check writing privileges, electronic funds, transfers, and customer service can add value and convenience. Reputable management. Choose funds managed by well-established institutions with a track record of stability and good management. The reputation and expertise of the fund manager are crucial in maintaining the safety and performance of money market funds. By carefully assessing these factors, you can select a money market fund that not only meets your need for safety and liquidity, but also provides a reasonable return on your cash reserves. Example of using money market funds in daily life. Suppose you have saved $20,000 for a down payment on a house and anticipate buying a home within the next year. Rather than leaving this substantial sum in a checking account where it earns minimal to no interest, you could opt to place it in a money market fund. In such a fund, your money would not only be safer, but also has the potential to earn a higher interest rate compared to regular bank accounts. Moreover, money market funds provide the flexibility of quick access to your funds, allowing you to withdraw the full amount without penalties when you are ready to make your home purchase. This feature ensures that when you find the ideal property, your funds are readily available, helping you act swiftly in the housing market. Money market funds offer a pragmatic solution for managing short-term savings without forfeiting potential interest earnings. They strike a balance between maintaining high liquidity and achieving slightly higher returns than traditional bank accounts, making them a superior option for safely housing funds needed in the near future. Thanks for watching. Don't forget to hit that subscribe button to stay updated on our latest videos and tips.